So we're very close to finishing a relatively interesting week's worth of trading. The reason why I use the word interesting is due to the gap which established itself between Friday and Monday's trading session. If you pay attention to my screen right now, what I'm going to do is simply highlight these two candlesticks. And as you can see, there was a difference between the close on Friday and then where the markets opened on Monday. This is generally what we would call a continuation gap in context of the location. However, what transpired really Tuesday through Friday is somewhat interesting as well. What we saw post gap is that on Tuesday, we saw the market begin to pull back. And as we closed or moved through the intraday's worth of trading on Friday, we have definitively closed the gap. Now, this is rather interesting because generally what happens is in the context of these continuation gaps, again breaking above macro resistance. If I zoom out and show you this, on the Dow Jones Industrial Average, since March 2017, we've been struggling to overcome this level here, coming in around 21,100, give or take a couple of points. Now, obviously, we've done that over the past 3 weeks or so, since the beginning of June. But when we see this type of price action, or what we call gap theory, we want to see the market continue. Now, it is generally an exception. It is, I guess, somewhat expected at these particular times to see these gaps closed. However, what happens next is very, very important for the overall structure of the market moving forward. Now, as we move into the final week's worth of trading for June 2017, and now that we have definitively closed the gap on Friday on the Dow Jones Industrial Average, it's going to be a make or break moment for the markets themselves, because the markets are technically trending. We're still holding up above the 10, the 20, and the 50 exponential moving average. Also, when we start looking at, I guess, the health of the trend itself in the recent breakout, this is where we start to intertwine the different areas of technical analysis, and we start saying to ourselves, well, if this was potentially a continuation gap, now that it has failed or it's back tested, does it fit the criteria of what we could assume to be some form of an exhaustion gap? Now, on this particular glance and looking at the markets right now, and again, the sort of the market breadth and the strength of breadth still continuing, I'd like to, I guess, say that it shouldn't be what we would assume to be an exhaustion gap. However, we are seeing the ADX turn down, somewhat definitively at this particular moment in time. However, the CCI, the Commodity Channel Index, is still assuming that the trend is strong. So we are getting a little bit of conflicted sort of signals, but this has been the case really since the breakout. The reason why is because the Nasdaq was the first market to break out above its respective resistance area. Now, again, this was going back a few previous months. We've run back up into resistance over here, just shy of 6,330. But we are still pulling back down into those rising exponential moving averages, and it still looks as though the trend is trying to continue. Now, in context of the Dow Jones Industrial Average, having come back down and fill its gap, and again retesting the rising 10 exponential moving average, you can see how the picture is a little bit different on that of the Nasdaq. Although we did, again, assume to have a gap between Friday and Monday's trading session, we didn't come down and fill it. So what looks to be happening right now is that the Nasdaq is making a rush all the way back up to 6,320, 6,330, somewhere in that vicinity. Now, I've been posing the question to a lot of people in that pro analysis class as to what happens next for the markets. Are we still assuming that the trend is going to break above these resistance swing highs? And if so, it's going to be another tremendous, I guess, trading environment for us as we continue on into July 2017. Or are we setting up some form of a channel consolidation sideways between support and resistance? Now, again, that question is largely unanswered, but what we can do very simply is say to ourselves, well, if we get back up into this resistance area and we start to see some bearish candlesticks, and again, if we look at our oscillating indicators, given the potential of a sideways market move, and if we start to see them move back up into relatively overbought over the next 1 to 2 weeks and then begin to roll over, then we can assume that these markets are moving into a sideways type of, channel consolidation rather than that of a trending market or an immediate trending market higher. This is what often happens during bullish advancements. We've been in a very prolonged bullish upward trend, which has been fantastic. We've seen a number of very successful trades play out. Just to mention a couple over the past 1 to 2 weeks, we've had Amazon from about $963 up to $1,000. That was a very profitable trade for people in that class. We've had Boeing Airlines breaking out above 187, also a continuation trigger above 192.60. We hit our target a number of days ago with this shooting star candlestick over here on Tuesday, which was very nice, all the way up at 199.44. So there are a lot of profitable trades that we have been oscillating through. We've got a lot that are also, setting up at the moment, which I am very excited about, especially in terms of risk and reward. We've also seen Google come up and hit that 1,000 figure as well. We've had some nice, decent trades on Netflix as well, coming back up, or oscillating back up, and Tesla as well, just to name another one. 334 and 346 up to our first target at 370. And then, of course, on Friday, we just hit our second target at 385.63. So a lot of these trades have been bullishly orientated. Now, that has been to fit the profile of the market itself as it has continued its breakout. But as the market changes, and this is what I'm trying to talk to you about right now, and this is the beginning of potential market change, or at least a slowdown again, not calling for a reversal whatsoever. But when you start to see clouds, so to speak, develop on the horizon, you need to start adjusting your perspective and potentially looking for some short side, orientated types of trades as well, just in case the markets do pull back. However, having said that, and the one market I haven't really spoken about yet has been the S&P 500, still holding above those short-term exponential moving averages. We're still above the 10 exponential moving average, and we actually closed the gap on Friday. So again, going into the discussion of a continuation gap between Friday and Monday, it looks as though we have filled the gap, or we have definitively closed the gap. And again, it comes down to a question of, do we continue? Do we bounce off these rising exponential moving averages, or are we going to see potentially a sort of a more prolonged pullback, even in the context of the S&P 500 retesting old resistance's new support, which is coming in just around 2,400, and then we should see the 1, 2, 3 breakout trend continuation. So we do have a little bit of, markets which is somewhat bifurcated at this particular time. When we start looking at the transportational average also, you can see that we're still not above its respective swing high dating back to March 2017. And if you look at the type of wave oscillation going on, you can see that it definitively looks as though we are oscillating between support and resistance. Okay, so you can see this, a really nice sign for the health and legitimacy of the industrial average moving higher would be to see the transportational average break above this resistance swing high over here, just above 9,659. Now on the dollar as well, a very quick update on the US dollar. We have had a number of successful trades. The most recent major move was below 98.35, coming down and hitting 96.39. That took a number of weeks, and there was a little bit of volatility down the bottom. But what we're looking for in the US dollar is for it to oscillate and to move back up anywhere around 99.21 on the index. And what that means for gold and silver, I mean, I haven't recapped these particular commodities in quite some time, but over the past couple of weeks, if not number of months, we've seen a number of really nice trade setups. I mean, the last one, the major one we had, was at 1673, and even pricing in at 1592 at the moment. Although we have seen the back test of this red box, it looks as though silver is going to come back down to 1533, even 1490 over the next number of weeks. And if I speed up the discussion and start talking about gold, we've also priced in a lot of healthy trades as well. We've caught a lot of price action. I've deleted those subsequent triggers in the past. But what we're doing right now is positioning ourselves a little bit bearishly orientated. The reason for that is because of this long-term primary downward trend line, which is still in effect, since 2011. And again, due to the inverse, relationship between the purchasing power of the US dollar and that of silver and gold, there is a lot of opportunity if the dollar strengthens and if it does run up to about 99 or even 100 on the US dollar index, to see a little bit of weakness flow back into commodities, whether or not that is on the macro trend to the downside or more so just a molecular level play, which is what we're sort of looking at in the world of technical analysis. I'll be speaking more about this over the weekend, and I would encourage you to have a look at Pro if you are interested in learning how to trade or successfully navigate the financial markets, the US financial markets. And this is our top 12 individual trade list over here on the left-hand side of my screen. So I wanted to wish you all a very nice weekend. I will be recording tomorrow that Pro analysis class, that 90-minute class. And again, I would encourage you, if you're wanting to learn and wanting to understand how to trade financial markets technically as swing traders, also if you want to use derivatives, it should be a class that you should be interested in. All the best, everyone. It is James signing off on behalf of Pivot Point Trading. All the best. Goodbye.